Brother Albert, how are you doing this beautiful Monday morning? The sky's out, minimal tornado damage. Did y'all lose power over the weekend, by the way?
No, but I mean, we were worried. We were worried, but everything was fine. I think the only damage I had was I have like one of those outdoor heaters. It blew over, and like the little top part was just kind of
Uh,
flimsy, bent. But
yeah.
I bent it back in place. I think this is like the second or third time it's fallen, so we were pretty safe. So that was good.
You will rebuild, right?
Yes, yes.
Good.
Marked safe from the tornado
Mark's
warning.
the February, the Valentine's weekend tornado of 2026. Never forget.
Never forget.
Cool, man. So life is good. Life is good. It is Monday. We are rocking and rolling with our legal series, our investor series. Today, we're going to be talking about entity structures. This is another incredibly important and critical episode in regards to real estate investing because Andrey came back. Thanks, Andrey, for joining us at Atlas
Glad to be back.
Tax
Thank you, guys.
Advisory. Andrey was on the call 2 weeks ago. We had Lynn last week talking about, like last week's episode was really good too, bookkeeping,
Hmm.
separating and coding, and it was really, really helpful and enlightening. And Andre was our interview that we had 2 weeks ago was so interesting. There's so many things we hit on that we felt like was important to go a little bit deeper on. And everything that we're going to talk about today is basically the title of a college class. So we're going to just barely just dust a little bit into to, to this world, but um, the main important goal is that we get our listeners, we get our investors and our clients and our mentees to start structuring some of these entities the right way because there's so many different tax advantages that we may or may not be taking advantage from. So we want to welcome Andre. Thank you again for being on the show.
All right.
Again, give us another 60-minute spiel. Tell us who
60
you
second.
are.
60
Yeah,
second.
60 second. 60 minute would probably be,
Yeah,
yeah.
take a full hour. Well, absolutely. Thanks for having me back. I'm Andrey Tetuyev. I own a tax firm called Atlas Tax and Advisory Firm. I specialize in real estate tax and small business taxation and a little bit of bookkeeping, a little bit of advising, consulting kind of thing. I've been in this industry 6 years now. Prior to that, I was a commercial lender for 17 years in three different banks. So I've kind of seen the range of things that come up in real estate financing and real estate tax and kind of some practical applications of that. So that's my background, lending, kind of converting to tax, and continue to see more and more growth in real estate. So I just want to be, again, a source of information to property owners, to operators of rentals and so forth. So that's kind of my focus and a big part of what I do kind of day to day.
Perfect. I love it. And you've already brought a lot of value to my world, to my business. Appreciate Alberto for connecting us. Um, got a lot of things I want to hit about today. So just to give kind of a brief intro overview of what we hope to hit on. So holding rentals in in your name as opposed to an LLC. Want to ask you before we get off the call about series LLCs, pros and cons to that. A lot of us are not able to answer the question, what's the difference between S-Corp, a C-Corp, or a self-directed IRA? What other type of entity structures? And why would you pick one over the other? What are the pros and cons? And then we really want to hit on community property today because that's huge, especially in the state of Texas. That's an important thing. So we'll go ahead and get started. So we just want to welcome everyone to the show. This is episode 42.
Nice.
42. We're still so this is now a habit, right? We've done this 42 weeks in a row with the exception of a couple of holidays. But why are we doing this? Because real estate is a great way to make money. And it's a fun way to make money when you do it correctly and when you know what you're doing. And the structures that we're going to discuss today is going to help you from losing your money. It's going to help you keep as much money as possible. So, Alberto, thank you. Appreciate you being here.
Yeah, yeah, I'm looking forward to it. This is actually I've learned so much working with Andre over the past I think over 2 years now. We've been working together, and he's really taken the time to educate me, and he's prevented me from putting my foot into places that they shouldn't be. So,
Yeah.
and he's actually helped me take my feet out of holes, that I've me and a previous CPA have managed to dig. But I'm looking forward to this subject. I love talking about like personal ownership, LLCs, S-Corps, C-Corps, even the self-directed IRA stuff. So that should be interesting if we can get into that too a little bit today.
So I want to poll the audience. If you're on the call, I want to ask you this question, and you can leave a chat on Zoom or comment on Facebook. First, first is the question is, how do you own your properties? So it can either be personally, who owns personally, and if you say, hey, it's in my name, go ahead and put that personally in the chat box. If you have an LLC, go ahead and type in the box LLC. If you have different types of entities, we want to hear from you. If you have some type of self-directed IRA, S Corp, C Corp, how do you own properties? So personal LLCs, want to hear from you. So personal ownership. So let's talk about that first, Andre. Pros,
Mhm.
pros and cons to my name is Austin Jones. I'm going to buy a piece of real estate, and Austin Jones is the buyer. What's the benefit of doing that first? Or
Well,
is there?
first, of course, number one benefit is simplicity. When you own it in your name, you don't complicate things, you don't have to file anything and keep up with state requirements. So it's very easy to own. And a big part of it, because tax for these types of projects are considered personal tax in that sense. So you file it on Schedule C or Schedule E as a rental. So it just passes basically directly on your tax return individual. It's super simple. So that's probably number one reason why people just kind of continue in that way. They own it personally and they don't try to figure out anything else. It's kind of all they
Yeah.
know. And that's where a lot of them start. And a lot of them stay that way for many years. And so that's kind of number one benefit, I would say. The second one is people are used to 30-year mortgages, so it's quite easy for them to understand. You put it in your personal name, you sign the documents, and then the rental could be financed that way as well. Typically, the lender will charge a little bit of a premium for higher risk, or sometimes people will just like
Hmm.
continue their initial mortgage, and it kind of in their minds become a rental mortgage later on. So it's very simple. Lending continues uninterrupted if you convert a personal house to a rental later on, or it's just much wider options available for a longer term. So if you're looking
Right.
for cash flow, that's where a lot of people try to do it in personal name and work with a lender that's much
Uh,
more easier in financing. So that's like probably number two reason, or maybe even for some, that's number one reason is just to
yeah.
get financing the best way possible. And that's kind of where I would say is the bulk of the benefit.
So it's not a horrible thing. It's not the end of the world. Somebody wants to start off. It's just an easy way to get started. Is it a challenge then if, down the road to switch over to an LLC, or is it easier just to start off as an LLC?
There are a few practical challenges. I would say number one, if you already have a mortgage on the property and you deeding the property over to the LLC you created, there's no tax issue because you're still an owner
Hmm.
technically. Especially if you're like a single member LLC, the cost of the property initially in your personal name transfer over to the LLC. So there's continuity there, but a lot of lenders don't like it. At least in the lending documents, it'll say that the loan could be callable upon transfer. So if
Um,
all of a sudden you're changing ownership to an LLC, some lenders, if they understand that and kind of learn in the future, they could create some problems. I haven't practically seen that happen, but
mhm.
technically it could happen. So you might need to eventually switch the property back to individual ownership from the LLC. And that's where the problem could come in if you made some decisions of, like with your LLC. So later, if you have a partnership down the road, and all of a sudden you need to scramble and transfer it back to your personal ownership, the lender could create a problem down the road. So that's
Okay.
probably where to be a little bit more cautious to think, what is the future holding? Are
Yeah.
you going to be adding to it? Is the lender friendly to that kind of transfer? Do you have a loan on the property or not? Those are kind of decisions could help you weed out like what's the best way to proceed.
So lender issues is the primary challenge when it comes to changing LLCs while you have the deal, the lender.
For the most part, just at least that's off, just like knowing that that could come up. Again, I have not seen it in many years of banking. I know my clients did it when I was financing those
Hmm.
properties. And smaller community banks may not have a big issues, but big national lenders with portfolios that are sold and managed, they could hold you to that agreement saying that you promised not to transfer ownership.
Okay.
So, but that
Oh
could
yeah.
come.
Yeah, that's interesting. So the benefits or the pros that somebody may want to go do buy it in their personal name. It's it's just easier to get started.
Mhm.
The financing can be simpler. Typically,
Typically, it's
um,
better too.
yeah,
You get
typically
better
it's going to be a little
rates.
bit
Better
better,
rates.
better
Mhm.
rates. However, that's not the end all to be all when it comes to how much money you're putting in your pocket. So, the filing, no filing fees, less paperwork, simple. The
Mhm.
con, the con I just heard you mention is transferring it later can get messy, especially when it comes to lending.
You
Mhm.
could,
Yeah. I
no
think I
question.
think scalability is probably, one of the bigger ones too, is as you're doing this, if you're keeping these properties, these investment properties in your personal name, eventually your debt to income ratio, because now the bank is looking at your personal finances, you
Hmm.
know, um, there's even though it says less paperwork as a pro, is I see it as there's actually more paperwork, because you're
Mhm.
having to provide W-2s and paycheck stubs
Sure.
and they're running your credit. And if your credit is not that great, then they want to see you pay things off, as
Right.
opposed to when you're doing things into like an LLC, they're primarily looking at the asset and not necessarily the person, right? They still run our credit,
Hmm.
when we're doing this as an LLC, but they're more interested in the asset itself,
I could see
so it's
that. Yeah.
actually a lot less paperwork that we have to provide when we're closing deals or refinancing or doing things in our LLC. So
Oh, for sure. Like you're saying, as you scale, that will start impacting your personal credit and personal cash flow. Because again, if you're buying a new house for yourself personally, all of a sudden you have so many mortgages. First of all, you can run out of how many mortgages you can hold in personal name. There's also limits there. But at the same time, like they may not be able to underwrite your rental income. Some lenders are a little bit more picky, but they will hit you on a debt service if it's on your credit report. So it
mhm,
could be a negative if properties accumulate, and that's the goal into the future. So
mhm,
it is cleaner to put it in LLC under the
Hmm.
tax another entity and just kind of especially if you're working with lenders that are friendly to that, they don't mind with a personal guarantee, but they still underwrite it kind of a little bit more flexibly in a business name.
yeah,
One thing I've always heard is the personal liability. They always say, if your contractor injures themselves and you have it in your personal, then they can come after you. Ha- is that necessarily true? Like being in an LLC, does that protect you from being sued and for somebody coming after your personal assets?
And again, that's more of a legal question, but I'll touch a little bit on what I
Okay.
know and kind of my experience with that. Yes, technically, nothing will protect you from being sued, right? Anybody could bring anything against you. And so the question comes in, would the LLC even protect you? Because LLC is a matter of state law. And so it is set up primarily for legal reasons, not for
Right.
tax reasons, because there's no like tax for LLC specifically. The only tax that applies to businesses is a corporate tax or partnership tax, that kind of thing. LLC is just a vehicle that's used by state to protect you in case of any kind of legal
Right.
liability. And the problem is a lot of people know that and they hear that, but they don't act like it. They don't act how the state law protects you. So they do commingling and really not staying to the formality of the state law protection. So they end up with an LLC, which is more complex, but then their action kind of undoes the benefit that's supposed to be built in. So I think, yes, that's the intent. You create a different entity and it holds a specific
Hmm.
asset or group of assets in case of any legal liability coming under that entity. Theoretically, only those assets are in play, for anybody coming against them. Your personal value, maybe your brokerage accounts, investment accounts, banks, personal properties, kind of like away from that. And so
Yeah,
that could be protected. But again, achieving that in practice is what's the difficult part for many small businesses. It's just many lack that discipline to understand the difference between running
sure.
things in an LLC or personally.
You mentioned commingling. So how would you define that word? Because we run into that a lot.
Oh yeah. Well, the easy way to describe it is just having no separation between how your money flows. Very,
Hmm.
very often small businesses, they withdraw personal money. And withdrawing money for personal reasons from a company is one thing, and it's an okay thing. But spending money that's supposed to be, spent from personal
Yeah,
accounts, from your business on personal needs is how that commingling comes in. Or paying things from one company on behalf of another company. Competent attorneys
yeah.
see that and they will bring all of those entities into one mix and they'll strip that veil of protection very quickly, saying that you don't honor the entities as separate legal entities.
Yep.
And so that's kind of the most practical thing. People paying things, moving money from this account to this account without any kind of regard to formality of what should be to flow funds.
And
So
every time Albert and I get a chance to mention this, we always preach this gospel. Stop doing that. Stop commingling. Stop using your businesses for personal expenses. You can't do that. You can't have a you're devaluing your company by doing that. And when you go to try to refinance it, pull an investor or sell it, and they see that all your grocery bills are on your business, and when they see that all your car payment and your Christmas gifts are all on your business, it doesn't look like you have a business that's profitable, and it's you're robbing value from your business by doing that. So that's my soapbox for today on
and
that. So
taxing a little bit, I'll kind of throw in a little bit of a
yeah,
taxing. You have an entity and you're commingling everything. Should you be audited, the IRS sometimes doesn't do a full audit. They may do like a limited scope kind of review of certain transactions. And if they ask for certain bank statements from one entity and they see funds are moving chaotically, first of all, you lose a lot of, credibility, reputation, because they'll start saying, well, nothing we see here is really, appears to be all together really entirely for this entity, and so that they could bring another entity into the scope of an audit because they'll say, well, now we see this, now we want to see your personal bank statements for the last three
right.
years. And so that just exposes you to more and more scrutiny if you have everything convoluted like that,
Yeah.
like true separation, how funds flow and what paid where, it really could protect you from kind of bigger IRS scope audits, from legal liability, from confusion in your books. Because if you keep your books and they don't mean what's in there, then it's like, how useful is that information? So there's just multiple reasons to try to be more disciplined in that
Right.
regard.
Liv asks a really interesting question. If there's commingling in bank accounts, but all is kept separate and accurate in your bookkeeping, is that okay?
It's technically not okay, because and that's how commingling works. People just say, well, I keep up and I kind of tease it out in my QuickBooks, for example. It's still commingling. You're
Mm.
still doing too much. The better practice is if you have one company, you need money into another company. If you do a direct transfer, do it properly with a proper promissory
Hmm.
note, treat it as a true loan. So there's formality between entities. Or just do a distribution. Take the money personally, put it in your
Right.
personal account, then inject it into your other company. So that's how it should flow. Then it's more clear where's money leaving, where it's coming. Otherwise, it's hard
Yeah.
to again discern. You may say that your books are clear, but somebody starts looking, to them, it's not going to be clear. Again,
Yeah.
and
Yeah.
somebody's the IRS is what I have in mind, because then they'll see that it's all together.
Right.
And not to
And
get too far into the weeds on that, on what Andre just said is, when you're taking distributions from one company to the next, and this is something that he's been explaining to me over the past few weeks that we've been meeting, is that could trigger like some tax implications,
mhm.
if you are taking distributions that are too big or too much for your
Yeah.
business. that could trigger some things. So if you're have these entities set up, like for instance, your S-Corp, right, you're using that for tax purposes, right? You have your
Hmm.
LLC, right? It's for legal purposes, and you're taking advantage of those things. Once you start commingling things like that, then if you ever get audited, right, the IRS can come back and say, hey, wait, you
Hmm.
had took advantage of this particular tax law here, but because you did this, we have to unwind all of that now, and now you have to pay extra,
Yeah,
less
retroactive
fees.
taxes.
Yeah, so you just got to be really
Right.
careful.
And
Also
if I
think,
could give quick two examples on what you just said, like how it works out. The big one is if you have an S corporation and corporation goes and borrows money, and you have, let's say, a rental holding company, and then you transfer that loan from your S corp into the rental operation, that could end up being a distribution in excess of shareholder bases in the S corp, and that's taxable. And it's
wow,
not a little tax; it's capital gain tax, typically long
yikes.
term, own the company over a year. But then there's net investment income tax. So you could be 18% tax that you will pay by borrowing money from this S corp and injecting it into your sole proprietorship
Yeah,
rental operation. And the IRS, you can call it a loan between two companies, but the IRS could collapse these loans and say,
yeah,
no, we don't trust, like you're really like classifying as a loan. So you can lose that status and it'll become a distribution forced on you, costing you a lot of money that you're not budgeting. So it's very easy to lose track of that, especially when S
yeah.
corporation is in.
And on top of that, buyers are going to scrutinize the bank statements and they're going to use the bank statements to verify the profit and loss statements. So even if your profit and loss statements are on point, um, if you're not using a separate checking account for that, it's going to be very confusing, and anything confusing is going to scare buyers away. So it's going to affect the resale value of that property. LLCs, single member
Mhm.
LLCs, pros and cons, Andre.
Again, pros, it's very easy. It's very affordable these days to file an LLC. If you do it solo, there's a lot of companies that provide it at pretty low cost. If you work with an attorney, it'll cost more, but it's still reasonable cost. It's easy to do tax planning with that because again, single member LLC is technically called disregarded entity, so it doesn't have its own tax classification. So the tax
Hmm.
passes through to the individual owner.
Right.
You own a business in single member LLC, it's taxed as a sole proprietorship on Schedule C of personal tax return. So it's simple. It's simple, and the big benefit is you preserve the right later to make an election to move away from that disregarded entity into an S corporation or a partnership or C corporation. You can
Okay.
make future choice once the entity is set up and you have bank accounts and credit set up under that company. Sometime in the future, when time is favorable, you can make that election to choose the different tax form. And
Right.
that's a big benefit kind of built in waiting for to be exercised later on.
So explain a little bit more how the taxing works, because is it based on how profitable that company is, or is it based solely on what the owner takes from the company?
Well, the way taxation works is what's earned, not what you take from the company. You're taxed on the money you've earned. So if your LLC is a single member LLC and you earn net profit from running your rental, let's say in this case, whatever you've earned, whether you take the money out of business checking or not, you will be taxed on the individual tax return. So once you have a profit and loss, so to speak, completed on Schedule E, if it's rental, you'll see rents received, expenses paid. The net number will just be added to your tax return. And if you choose not to take the money and it still stays in your business checking, the tax is not avoided by that, you know.
Okay.
If it just kind of goes into an amount that's already been taxed. So later it kind of adds to your equity of your sole proprietorship on the balance sheet. And next year, if you need the money, you can pull it out as long as you have that capital preserved from prior year that was taxed. In the year number two, there's no tax on that distribution. And so, as long as it's taxed when it's earned, it sits there in your company, and then you can always tap that amount, and the balance sheet keeps track of that.
So your profit and loss statement needs to have your income minus your expenses equals your net operating income minus your debt service. Put debt service below the line, right? Correct me if I'm wrong. And then
Right.
your tax on
Kind
what's
of
below. What's
presentation wise, it could be listed like the interest expense depreciation could be kind of below number,
yeah,
below net income. So you'll have more like an adjusted net income
yeah.
after taxes or depreciation. So they're just kind of a cosmetic kind of nature, but still you'll get to the final bottom number, like where you made money or lost money.
Yeah.
Then that's what will account for that tax year for you individually.
So I would say that's more your cash on cash return that you're being taxed on. Um,
Yes. Mhm.
you're after you pay your debt service.
Mhm.
I keep seeing debt service in the expenses, and that's not quite how we want to see things. So so the ease to file is the first thing you said.
Mhm.
What else there? We talked about liabilities on the personal. How does liability look like with the single member LLCs?
Liability, again, it's because LLC is a matter of state law, the liability protection would apply to that entity and anything that entity owns. Checking account, if the entity owns a piece of real estate, so anything in that LLC ownership will be protected if you properly operate it and you keep up with the formality. So that's how it protects you. The biggest kind of practical benefit of the single member LLC, like one I already mentioned, it gives you the right later to make a different election. If you
Hmm.
want to bring somebody into this operation, so later the LLC will start being taxed some other way, whether it's through a corporate form or through a partnership form. That's kind of one thing. The second one, again, day-to-day practical, is you can get credit in the name of that company and under the tax ID of the company. So that's where you can start kind of scaling and keeping your personal credit a little bit more clean looking. Because most business credit cards, American Express, Chase, Bank of America, all the big ones, they'll book a business credit card and it'll be only in the credit of the business.
Hmm.
Capital One still reports business credit cards under the owner's individual credit, unfortunately, but all other creditors I know, they separate that. So if again, going to apply for your personal loan, it kind of cleans up your credit. It could still be something that's disclosed properly in a personal financial statement, but that's again the nuance of each lenders, how they hold people accountable to the process of loan applications. But it really simplifies your personal credit life. And you can have all kinds of mortgages in the commercial side, all kinds of credit and personal financing notes, and that kind of stays in the scope of that specific entity.
That's good. That's good.
Mhm.
So ease the file. So the pros of a single member LLC, ease the file, the liability protection against your personal assets. Obviously, your bookkeeping is just going to be cleaner. It's going to be easier. Um, changing structures, entities is not going to be as messy coming if it's coming from an LLC, adding partners. And then you mentioned uh, the you mentioned banking. Say that one more time. You said something about financing.
Yeah, personal credit gets a little more separated from the business
Okay.
credit. So you have a little bit more of that separation on the credit report.
Okay, awesome. So perfect, perfect. So just to clarify, like any misconceptions, in LLC, it's not magic protection if you mix funds. No, there needs to be an operating agreement. That's we're hoping to have an attorney come on next week that can help clarify some of this for us. By the way, I'm not an attorney or a tax advisor or a medical professional. I just have a real estate license. Anybody can do it. It's easy. Just kidding.
Okay. I'm not trying to give
Um,
life saving advice here.
Absolutely.
so none. This is just for entertainment purposes only.
Education.
Yeah. Anything else? Anything else for the single member LCs?
I think that's a good kind of a set of benefits you just outlined. That's a good place to start considering all that.
Do I need insurance for my LLC?
It depends. Like you can have general liability coverage. It just depends like what activity is in that LLC. If it's rental, you typically would have a policy on your property and that could
Okay.
have a general liability amount built in. So you might already have some protection kind of there. But you can certainly get some kind of umbrella coverage or some other insurance policy that protects you individually, and so that's some insurance planning you can do. But most people don't go and get like a separate insurance just for the LLC after they file one. They just kind of rely on existing policies, hopefully filling the gaps as they could exist.
Right.
I feel that. Albert, we got 15 minutes left. We need to talk about community property and we need to talk about Series LLC. What's your pick?
I don't think we're gonna make it to self-directed IRAs.
And
Oh,
Um,
we got to do so. Yeah, that one too. So A, B,
I,
or C.
yeah, I mean, so I think Series LLC.
Mm.
what's the word? That's something that I'm more interested in is
Mhm.
Series LLC, just because we own a lot of properties, and Andre and I have talked about it a little bit too. So I think that would be interesting to talk about.
Yeah.
Perfect. Yeah.
Yeah,
And
like
again,
when does
And
it
by the
make
it just
way,
sense? Yeah.
real quick before you start on that, Liv was asking about
Oh,
entities that you can put your rental under where it won't be passed to your personal return. An LLC or a Series LLC would be the answer to that, right?
ultimately, the only way to put it in an entity like a C Corp, then it'll have its own return. Anything else will still pass on to you, whether it's through K1 if it's a partnership or S
Hmm.
Corp, or you'll just disregard an entity flow to your Schedule C or Schedule E on the personal. So really, like anything you'll do in an LLC will end up on your personal return one way or another. It'll pass to you, and that's just the
That's
reality of how taxation works.
that's why it's probably a good idea to have the same CPA for your LLC as you do for your personal.
Generally,
yes.
there's some ways to kind of like, of course, plan this and be aware of all the pieces. Of course, like that
Hmm.
would work out best, I think.
So Series LLC, when
Okay.
does this make sense? So first,
So
how would you define this? Because I didn't know about this until like 2 years ago.
it's relatively new in Texas. When I lived in California almost 20 years ago, it was like so common there. In some other states, it's been around longer, so it's a more known structure. In Texas, it's been around, but not like terribly, terribly long. So people are still kind of new to it. What I would explain it's kind of it's an LLC that's set up that serves kind of as a master LLC purposes. And you can make, when you form the entity, you can make a provision to the state to let them know that this entity is set up as a series and it'll have additional companies kind of coming forth in the future as they become needed. And so as such, you have an LLC that's recognized by the state, and then within that, you can add additional filings. You do like a DBA name
Hmm.
within the series that you've set up, and that adds it to kind of to be a separate legal entity within the structure. The benefit of that is for tax reasons, you have flexibility without forming a new LLC from the beginning. So like you
Right.
could. Right. If you don't have that set up, you would have maybe 10 different LLCs, which means you need to file 10 different companies, which the filing fee itself is $300. And so if you do it 10 times, that's $3,000 you'll need to just to pay to the state, not including any filing fees or
Yeah.
attorney. So that could become cumbersome if you want to put one property per LLC. Your bookkeeping could be a little convoluted because you'll keep books separately. With Series, the plan is to just keep acquiring properties and create a new subseries in
Hmm.
that time and kind of put it in that title. And so with that, if ownership is the same in sub-series as with the master series, then you file the same tax return. Nothing changes. You just add yet another property on Schedule E, let's say, and it still stays within the same kind of framework. But you could take one of the sub-series and you can split it out to make it a partnership. And so then you can file a separate tax return for one of the sub LLCs.
Oh wow.
You partner there, but not a partner in this other one. So it gives you like greater way to customize. But on the negative side, what I would tell you, being a banker for a long time, many banks don't like these kind of structure. When I worked at Chase, Chase would not allow even banking account to be set up if they find out the company's serious LLC.
Mm.
So they would either close your checking account or they would not proceed with account opening. Some local
Why? That
banks
seems
don't
like it would be better.
it's just for some reason banks in Texas still find it to be too exotic of a structure. They for some reason don't trust that structure. I don't really know why. There's no really gimmick or any kind of legal difficulty there. It's just a way to structure it. But banks I know are really kind of hostile to it for some
Mm.
reason. When
I
I work
bet
at a smaller, yeah, go ahead.
I was going to say I bet there are some banks that are more open-minded about that kind of
They are.
structure.
And when I worked for a local community bank, we were more comfortable. We would do financing for a sub-series kind of entity, no problem, as long as it's properly documented and you have your operating agreement in place and everything was clear. We did that and there was no issues, but big banks don't want it. So
Yeah.
just be aware that it's a more complex structure. People also have a hard time. I've seen many times where I start engaging with a new client and I start looking in their documents and they have like a serious LLC setup, but you look at bank accounts, they still don't understand that they need to set up a new bank account under each sub-series. They still operate everything in just a master name and the
Mass
bank,
when
property ownership. Even though they've created this elaborate system, they still didn't progress beyond the master LLC's name and they operate only in that. I see that very often, you know.
So the
And
way that this makes sense in my head, and Albert, give me your perspective. But if I'm going to own 10 properties, you know, I'm going to have one account with my credit union. And by the way, more credit unions are probably, it seems like they would be more open to that than like your Chase and your Wells Fargo and Bank of America, et cetera.
yeah,
Because in a lot of credit unions, there's no limit to how many checking accounts you have. And then inside the credit union, I would do a separate checking account for each of my properties. Tell me if I'm thinking about this or if I'm
And
overthinking
you
it. So
can do it. Yeah, you can do it that way.
so they're connected. They're still it's the same login, same website, same bank login,
Mhm.
but each property has a separate. And we talked about this with Lynn. But the way we were talking about with Lynn and bookkeeping is, you know, if you have X amount of real estate, you do it all under the same checking account. To me, now I'm thinking like especially as a real estate agent and knowing that like they're going to be scrutinizing bank statements when they buy these properties, it may make a lot more sense just to have a separate checking account for every single property and having it set up as a series LLC kind of makes sense when they're all connected with the same. Am I thinking about it right or am I overthinking it?
I think yes, like that's why a lot of people kind of gravitate toward that because they're saying I'll separate it. But I guess in reality, what I'm saying is just hard to do because people will do it one, two, three checking account. Before you know it, they start getting confused. They're paying bills
Yeah.
out of this account on behalf of this entity. And
Hmm.
so they have like multiple debit cards they're carrying, multiple credit cards, or they'll get a credit card under one Sirius LLC, but then they tap out all their unsecured credit limit and then they can't get one for the next one. So it practically is hard to carry out if you have 10 different sub-series with its own bank account, its own credit. It just gets like to be administratively really burdensome. What I would
Hmm.
say is
I
if
see.
if you have an asset that's really valuable, like a shopping center by itself, there's a lot of value in it. Putting it in a separate LLC is fine, generally, in my experience. It's not a big burden to maintain. Once it's filed, it's only one filing a year, at least in Texas here. I can't speak for all states. And so it's really kind of easy to maintain. And if you have another project, you can create another LLC if you choose. Or if you feel like you have enough liability protection, enough credit in that LLC, maybe you don't have much to lose at stake. You know, if somebody like sues you and you have a loss
Hmm.
of some crazy reason, then you might have some equity in that LLC, but not a ton. And so maybe you're
Right.
comfortable putting a few properties under one LLC. It's all, you know, there's one way to say there could be a benefit if you can carry it out. The problem is for small business, it's really hard to carry out that
Yeah,
structure. It's
I
just
see.
becomes very confusing, very easy to make a mistake and use the wrong thing. So that's where I think is the negative is. If you can do it, it's a great structure.
Yeah. It's not always practical. What were you going to say, Albert?
No, I was just when we were talking about bank accounts, I think like what was the easiest thing for me was having one bank account with our LLC, right? And there's only business expenses coming in and out of there. There's no personal things coming in and out of there, and then separating it on the bookkeeping side, right?
Right.
And so that's because I would definitely get confused if I had, 10 checking accounts. Like I get
Hmm.
confused with two checking accounts.
Yeah.
If we added five
Um,
times that, yeah, it can be
if
administratively harder for me.
I think I have like six LLCs in our family, and it's as diligent as I try to be. Just every once in a while, you'll grab a wrong card, or
Hmm.
you'll just do an ACH payment to the wrong thing. It just happens, you know. And the more of it you multiply, the more you have to be so diligent, and it's hard to do. So, but if the intent is there, and for the right personality, and the
Yeah.
right project mix, and the right assets, you know, it's a structure that could work. You know, just do your
Yeah.
due diligence, talk to the bank that you have in mind, consider difficulties on the credit side because lending for a Sirius LLC could be even more narrow than the checking account you can open for a Sirius LLC. That's just the way it is.
It doesn't seem completely practical, but the benefits of being that organized can be extremely powerful because I was giving Lynn the example, if I go to Home Depot and I need to buy plumbing for unit A or house A, like a separate property, and I need to buy some wood to replace the fence for B, and then I got to buy something for C. I'm buying three things at the same time. But in my books, if there's a way where I can show here are all my income and expenses for unit, like you still have to be able to separate that the material for that plumbing job on house A or building A is separate from what you purchased. Like you still got to be able to show that because if I go and sell building A, I'm still going to have a clean profit and loss statement. I'm still going to
Mhm.
have to have a bank statement that verifies
Yeah.
that profit and loss statement. So uh, that's why
Sure.
we need help. This is why we get people on our team that can help us keep up with that kind of stuff.
For sure. And like again, practically speaking, where a little bit of challenge is if you have a property that's losing money and you have another one that's
Yep.
making a lot of money, and the way netting works and passive versus active, like we discussed the last time, it gets really weird if you spend all of it kind of in one ticket and arbitrarily
Yeah.
allocating costs to this or that project, because you're not going to have an invoice if we go to Home Depot. You're not going to have anything to really like prove and tie expense to the property
Yeah.
that. And so you can create the scenarios where it's like, a lot of expenses is added to one property could result in a loss, and the loss could be suspended. So
Yeah.
it's just the way it is in small business because of how purchases are made. It's more simple. It doesn't go through requisition and the purchase order. It's just transactions happening in the card and you just allocating them per property.
The answer
So
is suck it up and get organized and code your stuff
yes,
right because
that
one of your properties is wildly profitable and another property is bleeding money and you can't tell which is which because they're all mixed together.
Yeah, and that's just for your clarity, for your planning. Like, what is a successful property versus not? Maybe you need to exit one and try to, kind of invest in a new asset. So, like, knowing good reporting is really important. It'll hopefully help you make good decisions. That's the intent beyond tax, what bookkeeping really should accomplish.
Yeah, absolutely. Absolutely.
Cool.
Do we have enough time to hit community property? Because this is a big one too.
If you
Yeah,
want
we
to
can
skip
briefly touch
self-directed
on that.
IRAs.
Or self-directed IRAs. Flip a coin. Andre, you can choose.
Well, we can talk. Let's talk a little bit on self-directed because it's something I see more and more because it is popular on different social media and people do hear about it. And I get approached all the time. People are asking for advice how to do it. And in a nutshell, self-directed IRA is just it's nothing too complicated in theory because just like you buy assets like stocks and bonds and
Hmm.
different things like that within your IRA, some IRA custodians will allow you to buy other things like buildings, like businesses, like assets that are just more fancy and maybe produce more income if you're an expert operator in a specific field. And so a self-directed IRA is just a retirement account opened with a custodian that could allow for
Hmm.
that. And there are plenty of them. There are plenty of really good ones, and they're not terribly expensive to set up. But they are complicated. So ultimately, if you leave your job and you have a big 401k and you can roll it over to your own 401k if you have one in your self-employed life. And that allows more flexibility on the self-directed structure because of certain exclusions and specific taxes that could be present there in the self-directed accounts. Or if you roll it 401k to an IRA, you can still end up buying a rental property
Yeah.
within that. It's very easy to execute. It is more challenging to kind of maintain because people, again, often commingle. And with an IRA, you can create a prohibited transaction.
Yeah.
And so you could create something that will disqualify this asset being in your retirement. And as such, it'll trigger a distribution, including a penalty for early withdrawal. So it's a very big topic. It's very flexible. If people really want to start with real estate and they think that they could do really well, better than stock market returns, and that's an easy way to go get into it. But financing more challenging because you need to either find a lender who could lend to IRAs that because with IRA you cannot provide personal guarantee to a loan.
Oh, okay.
If you provide a
Oh,
personal guarantee like an IRA loan or credit card that you use in your IRA name, then it'll be considered a prohibited transaction. It'll disqualify you. You'll create this tax event without realizing it. And so it
That's
gets
interesting.
really convoluted with the rules and who can participate, what activities you can do yourself because you're the owner of the IRA. You cannot provide any physical labor in your rentals. You can only do management functions only. So it's a sophisticated strategy, and I have one property personally that I own in the self-directed IRA. It's a commercial shopping center, and but I've been really mindful to make sure everything is done not by me, but we have a property manager on site, and they handle everything. I'm just truly as just a manager on behalf of the LLC that's set up for that purpose. So really interesting structure,
Oh
and
my gosh, we can go so deep into what you just said.
I have a question though, like, now that you said that you've got this commercial building in your IRA, so and that's with a custodian, right? So does the custodian educate you on the do's and don'ts, or is that really kind of your responsibility?
it is your responsibility. They do, like my custodian, they sent me a PDF document that's 300, 400 pages of different rules. And there's a lot of rules that apply, and some of them don't apply in your specific scenario. So, for example, if you're just buying real estate, there are particular rules that will apply. Like there's specific tax that could be at play without you knowing it's there.
Mm,
So with an IRA, IRA is a trust. It's not a business. So if it starts operating a business, you will be competing against other businesses that are not run in the trust. So for that, IRS created a separate tax called UBIT tax, unrelated business income tax. So if you create net profit in the IRA that's self-directed, the tax is not, it's a trust tax. It's like 40% tax. It's really like prohibitive, because IRS doesn't want you to use your asset money and compete with local businesses that are operating at higher cost of capital. And so that UBIT tax becomes something to be aware of unless you operate a self-directed 401k. That's where I said it has more flexibility to avoid certain extra tax. Or if you use financing, if you go and you find a lender that's comfortable financing a self-directed IRA asset, they do exist and they'll finance 60% of the purchase price. But the problem is there's another tax that applies to the extent you use financing. It's called the UDFI tax. So it's unrelated debt financing tax.
mm,
And what this is, have a loan on the property. If you make a profit, the percentage of the loan that's used up on acquisition of the property is taxed.
mm.
So that's why it creates a lot of specific rules that when you start telling people of the nuance, and I have a simple guide, like I mentioned, that I received from this trust company. It's like 400 pages, and you just look at all these provisions of what you can and can't do, or be careful with who you do business with.
Hmm.
You can't operate with your family members if they're providing kind of service to your rental, and there's just a lot of unique things to be mindful of. So it's not for everybody. But for an operator that's maybe done really well in rentals and they know how to work it and they produce amazing returns and now they want to leverage their retirement funds and get more into that field, it's definitely on the table. You just kind of have to be mindful of what kind of financing, no personal guarantee, no personal labor. You have to just kind of know the big kind of things to see if it's even fitting what you're trying to accomplish. If
Mm.
not, maybe not a structure for you. So I've done one and I've kind of enjoyed it. It opened up some opportunities for me to get experience in commercial real estate sooner than I would have maybe otherwise. And so for that, I'm thankful for that structure.
Cool.
Okay, we're gonna have to end, but Albert, I want to come back. I want to relook at our schedule for the rest of the year because I think we can spend a month on this because
Yeah.
going back to community property, that's
Yeah.
easily an episode.
Yeah.
I think there's so many interesting things. Honestly, what you just said about self-directed IRAs probably brought up more questions than answers there
Mm.
because I mean,
Completely.
300 pages. Um, because there's some very powerful benefits of this, but there's some tax implications that I was not aware of that you
Mm.
just brought up. So, um, but let's get lunch, Albert. We'll figure
Yeah.
out how to come back to this later this year, because I think it is very powerful, and I think that based on some of the questions that people are asking, um,
It's an
yeah,
interesting subject. Yeah. It's very
yeah, it's
interesting.
it's important.
Mhm.
It's important. So,
If you can just give me 2 minutes, I'll touch on one
yeah,
important thing for the
yes,
community
sir.
property state, and who could be, expanded later. But what I would say in Texas, what I see all the time is a husband and wife set up an LLC. They're 50-50 owners. they buy rentals, and they operate. And so really like with IR, in IRS eyes, by default, the normal decision, if you have an LLC owned by more than one person, you're not a disregarded entity. You are a partnership for tax reasons.
Okay.
And the partnership is the most complicated return you can do because it's very custom. It's not as rigid as S-Corps are. So there's a lot of things you can do with partnership tax planning. But for that reason, it's complicated and it costs money to file partnership returns. And so most people, if they file an LLC with two people, you can say, well, now I'm stuck with a partnership for tax reasons. And that's an
Hmm.
admin burden a lot of people don't know they'll have to carry. But in Texas, because we're a community property state, if husband and wife make this purchase and they own this company together, they can make an election to not file a partnership return. And it's really like a great benefit, for community property state because you can operate an LLC and still file it as Schedule C business.
Yeah.
You have that choice, so you can forego partnership taxation and still maintain simplicity. And there's other things you can make certain qualified joint venture in other states that are not community property state where there's certain decisions you'll have to make when you have an LLC and it's owned by more than one person, how it's going to be presented for tax purposes. And in the community property state, because the state will treat the LLC owned by two people that are married as the sole proprietorship. So that's how IRS will allow you to be treated if you choose to do so. And
I
so
think that
that
applies
choice.
to a lot of people that we're talking to right now.
And like I have a couple of properties me and my wife own, and it's an LLC jointly owned, but we made an election not to do it as a sole proprietorship. So I file a partnership return for a specific reason in my case. So we get a K-1 and all this stuff.
Hmm.
It's more complicated way to file a return, but I could have foregone the tax in the form of partnership in my case because I can just file it on Schedule E or Schedule C, whatever is more applicable. And so that element is really useful in planning how you're going to proceed. But if it's not a spouse, let's say it's a partner and a partner, then you created a partnership having two people in LLC, and that entails a partnership return. And that whole topic of partnership tax is really, really
Huh.
broad. There's so many flexibilities built in. There's so many things to think through how it works. So that's like if you want to like talk about that element, that's like a
A whole nother.
discussion point for a
Yeah.
day or two.
Let's do
That's
it.
a very
Okay. We will.
interesting.
We'll use this. We'll use today's episode as a bookmark, and we'll certainly come back to this. Albert, any final
Perfect.
words?
No, man, this is again, I just feel like we're just kind of scratching the surface. I
Oh, yeah.
know we could just nerd out and talk about this for hours. So I do like the smaller chunks though. Andre, thanks again, man, for your time. It's super, super valuable for our community. We're looking forward to having you on again as soon as possible. Austin will take care of that. So it was a really great call today.
Yes,
All right.
sir.
Thank you.
Audrey, how do we get in contact with you today?
My company is Atlas Tax, as I said. So I have atlastax.net is my website, and I have contact us button there, so you can reach out to me through my website or just Andrey Andrey at atlastax.net. And we can connect and discuss what questions you might have. I'm very interested to educate people and not just make all these choices for you. I'm
Mm,
more in the business of laying out the range of options and kind of work you through how to make them and benefit your business.
awesome.
Well, we do appreciate it. Grateful for your time, and we'll wrap up our series, our tax strategy and business setup series next Monday. Have a wonderful week. I'm Austin from Houston, and this is my brother Alberto,
That's
my
it.
brother from another mother.
All right.
And have a wonderful week. Go work hard. Bye.
Bye.
All right.